welcome to the NREP Daily right here on the National Real Estate Post. We have Barry Habib with us once again. And before we get started, Barry, just got to let you know, Oak Tree Funding, they are our sponsored non-QM lender. You know, non-QM certainly took a hit, but they're all bouncing back. And of course, Oak Tree as well has bounced back. Right now, they want to let you guys know they're going up to 85 LTV, which is quite high, non-QM right now, up to $1 million. 75 LTV, 12 to 24 months bank statements for your self-employed, etc. They'll do cash out in Texas. They've got loans to $2.5 million, and they'll do a 660 FICO. So they've bounced back very, very strong. If any of that floats your boat, or if you think you need to take a look at some non-QM product, just click the Oak Tree Funding banner you see right here on your screen. It's right below. Just scroll down under the video, click on that banner. You'll be able to get a hold of an AE over there at Oak Tree, and they will help you out there. Closing these things like crazy now. They've got plenty of paper to lend on, and they are good to go. So good news there.
So they've always been there.
They have. They never left, man. They hung in there, and as a bunch of others did. But Oak Tree's just one of the. They're awesome. They're a great company to be involved with. Give them a try, and you'll find out. Let's see. So let's just do this, Barry. You know, here we are on Monday, and I was just kind of hoping that we could take a peek at, kind of like what happened last week, and that was notable in your mind. And then also going forward this week, what's coming? What are we looking at this week that might, cause the market to react one way or the other? So what do we got?
So the big thing last week was the Fed, of course, and of course the action in the stock market, which, by the way, we did kind of call that turning point on our daily updates. However, the Fed. Well, that was a big one. You know, the Fed saying, hey, we're essentially unanimous, which you almost never see, of keeping interest rates pretty much at zero until 2022. Now, that could change, but their expectation for unemployment was a little higher, I think, than the market was thinking. They think that unemployment will be persistently high. That's one of the reasons why when you take a look at prices of stocks and you say, hey, this is kind of equivalent to where we were back in October, November of 2019, but yet the economy feels and looks very, very different than it did back then. So do you justify these high prices? And what was interesting, Frank, is that it is eerily similar to some previous crashes where you see a big downward move, then a euphoric rally off that bottom, but that's when the real negativity hits, and that's when you get a much, much longer and deeper downside move.
Gotcha.
1929, just for a quick parallel, big crash, 48% rally, and then the big damage came. Just to mention, big crash back in March, 47.5% rally, and lately you've seen some turbulence to the downside. I'm not saying it's a repeat, but as Mark Twain said, history doesn't necessarily often repeat itself, but it does tend to rhyme.
Very, very clever.
Yeah, and brother, you know what? We do have some housing data this week that'll be very closely watched.
Yeah.
Because the housing market, look, you know me, I've been extraordinarily bullish on housing, and
right.
I'll say that, I'm very proud of our record on that. However, I think the market is a little bit overly excited about the rebound that we've seen in housing. I don't think that housing is impervious to this, Frank.
Okay.
Because, we have seen a huge rally in housing, but we've had pent-up demand. People were locked down, and they do want more space. They do want more distance. But I think over the long haul, we've got to think about, what is going to be the result of unemployment, because we know that the unemployment rates and the ability to purchase a home are pretty closely correlated. So I'm bullish on housing. I think that housing will do well in the long run. In fact, I think 2021 should be good, 2022 should be good. But I think it's going to be a little bit lumpy here. We've gotten a great sprint. I think maybe it slows down a little bit second half of the year. Still healthy, still okay, but more flattish. I don't think it's going to go to the moon here, second half of 2020. But as we start to see unemployment come down, hopes of either better testing, better therapeutic, maybe, God willing, a vaccine, you'll start to see housing really start to pick up as unemployment comes down. As will interest rates improve too, because there's a lot of premium in interest rates right now. So I think interest rates have a big opportunity to stay low and come down. Not because the Fed said they're going to keep rates low for a while, but because there's downward pressure on rates in a lot of different ways. Even just demographically, 11,000 people turning age 65 every day. They're moving out of stocks. They're moving into more safe assets. That's going to put pressure on the bond market. Debt that we've acquired here in the U.S., every time in history, every country that increases debt dramatically causes rates to be under pressure to the downside because the servicing of that debt is a drag on growth.
So when do you think, so I appreciate your outlook on housing and what your thoughts are on housing. And I kind of want to circle back to what you said, which is I think maybe people might be a little overexcited a little early on housing. Maybe you could, just expand upon that a little more. Why do you say that is what I'm curious about. And then also, do you think this is going to be like the fall or the winter or even next spring that you see it to be more of a normalized, housing market as far as, a good normalized housing market?
So we've had a good market, and I think that we'll continue to do so. But this is strictly my thoughts on this are A, we've had a spurt because people have been locked down. And B, I think that the persistently high rate of unemployment, which we'll see. I mean, look, this Thursday, we're going to get initial jobless claims. That's people filing for unemployment benefits for the first time. You're looking at about 1.15 million people. And people are cheering that and say, oh, that's so great, because we had seen it at 6 million or 5 million and 3 million and 4 million, whatever. However, we were accustomed to about 200,000. So it's about 6 times worse than normal. And it just doesn't go away. These people have to either come back to work or find a job. So I'm still concerned about the rate of unemployment, and it does have an impact on housing. We know that throughout history. I'm not saying it drags housing down. I think that housing just kind of muddles through the rest of this year. And then as things really start to come back in 2021, 2022, we see it improve. But here's the driving forces. It's shocking, actually. It's people under age 35. People under age 35 are driving growth in housing. And in shocking fashion, even those under 25 are really seeing a surge in their purchase of homes. Those under 30, big surge. We know that childbirths drive housing. And if you look at Google Trends, baby registry is at its highest level of interest in the history of trends. So I don't know, maybe it's all that lockdown stuff. Maybe some people got busy and we're looking at maybe some babies being created, but that's very good for housing in the long run. So if you're out there and you're saying, how do I market to this? How do I capture this? Instagram's a real good place to be, because those under 35, that's the first place they go for their marketing. And a lot of people say on social media, I'm all good because I'm on Facebook. That's good. But you should also be on Instagram, because that's going to be where the real driver is of future growth in housing. And we're seeing it already.
Yeah, I guess I would have to say that I do agree with you. I think that going forward, it's going to be interesting to see how housing really does unfold with respect to unemployment, because one of the things that we do have right now is a lack of inventory. Overall, there's a lack of inventory. And, so that's going to create more of a demand, that type of a thing. And we would hope that we could see some inventory coming back, in the future, of course, because that's just to help kind of normalize things a little bit. But my thought is that with respect to unemployment, et cetera, I think that, just me personally, I think that I don't think we're going to see a lot of inventory coming back very quickly. And the reason being is, you've got people who own homes, and a lot of them, they might be in that forbearance situation right now, right? So even though they'd like to sell, well, if they're in that forbearance situation, they're in that forbearance situation because they have an employment issue, which means they really can't list the home. They can't do that. So I'm just really curious to see what really does play out. And I agree with you too, because I think right now there's kind of an initial kind of, I'm out of the house, maybe we go buy something, kind of a frenzy going on. But I think you're right. I think we shouldn't be overly excited about that. Of course, happy about it, but not overly excited, because we really need a little more time to see how this is really going to play out for us.
Yeah. So what's in demand right now is more space, meaning more interior space and more distance from others. So you bring up inventory. It's very, very interesting. It's a very smart point you bring up on inventory, because inventory is sparse. It is scarce, especially if you're in the suburbs or the real hot area of the housing market, which is the next outer ring, the exurbs. However, want to hear something crazy? Apartment inventory in the urban areas up 34%. So non-owner occupied rentals, for example, inventory is up 34%. Everybody's complaining there's no inventory. Well, those that were non-owner occupied that are being put back on the marketplace, inventory is popping up on those. So those tend to be in the city areas. And listen, there's a lot going on in the cities right now, aside from just COVID, that are causing people to maybe think twice about making a big investment in city areas.
Yeah, there was, I reported on it last week where there was actually NAR came out, someone from National Association of Realtors came out saying that it's interesting that the suburban areas could see a nice burst of home sale activity simply because more people are able to work from home now. This has been proven, emphatically proven to a lot of companies who are going to be able to say now, especially some of these can be, very wealthy companies that pay very generous salaries to people who are more tech based, who are based in, like congested city areas. Well, now they've got employees that they can say, well, guess what? You can work full time from home now. Well, now that guy who can work full time from home, hey, I'll move to Boise, Idaho. You know what I mean? I'll move anywhere in the country now because I can work from home. And now I've got this big fat salary, this big fat Northern California salary that I can take with me, wherever I want to go. So the suburban areas are definitely going to probably see an increase. And then the other thing, another article that tapered or went right with that was another gal was saying that another reason, just like you said, Barry, the reason that people are kind of wanting to spread out to really get a little more room is just because of the whole pandemic, and because maybe I don't want to be so close to my neighbor. Maybe I want a little space. And now that I can work from my house and still make my salary, I don't have to drive in there. I can move out a little farther and go to those areas. So
you're precisely right. Yeah, the exurbs, which is that next outer ring, that's kind of like the hot marketplace right now, right? And when you take a look at the individuals that are moving out right now that can do this kind of work from home, I just want to make one point that I know that everybody's kind of resigned to the fact they think it's the same thing working from home. Look, I think it's a good substitute, but it's my humble opinion that there is nothing like the collaboration where you just overhear somebody say something, they're sitting next to you, they're in their office, you walk down the hall, you sit with them, you look at something at the same time together, you get input. I just think that what this might do is people just accepting this as, oh, it's just as good. I don't think it's just, it's as conducive to creativity and collaboration. So that's my humble opinion.
And I'm gonna agree with you on that because I think we've had conversations while we're going through this personally with each other where I was telling you, man, I don't know, I think we're gonna let the office go, and we're doing it from home, but over time, we realize, oh, this kind of sucks. We kind of need to get back there because we kind of need to be together for that very reason, which is it was better when we could bang things off of each other. It was better when our salespeople, hey, I got a question, and it's just right there. We can answer it. It was better, So we are moving back in. We are downsizing though because we realized a couple of guys can work from home. So and it doesn't matter to them. And so, but all interesting stuff. We got to get moving here. So
rates should be good. They're going to be volatile here. Be careful. Stock market will be extremely volatile. Be cautious. Housing muddle through, but it'll be really good.
So as far as this coming week goes, what are we? Are we cautiously floating or something?
Yeah, we're starting off floating. We're starting off floating. Watch around 70 basis points on the 10-year Treasury. 70 basis points on the 10-year Treasury is a really important spot. If we can break underneath that level, we could see a big rally. But it's going to have a little bit of a tough time breaking underneath 70 basis points. But the Fed's still in there buying. We don't have something called yield curve control yet where they've bought enough to limit it, but we're like next best thing with all the Fed buying we're seeing. During the height of all the QEs in the past, they're buying $40 billion a month. Well, now they're buying, get this, Frank, they're buying $100 billion a month now. And that's a big reduction from where they were. So big influence to keep rates down from the Fed.
All right, man. Well, great stuff, Barry. Always a pleasure. And we'll be back next week and do this again and going forward. So you guys have a great week coming up. Cautiously floating. Keep in tune with what's going on. Of course, subscribe to MBS Highway. If you haven't done that already, we'll be sure to put a link down below. Subscribe to us if you're meeting us for the first time. And leave us your comments down below. We always appreciate that. Until tomorrow, we'll catch y'all later. Thanks, Barry.
Thank you, buddy.
See you guys.